Hello. In this video, we'll continue with our discussion of the deductibility of losses. Now recall that for a loss to be deducted, it must be considered a loss, which deals with, again, considering the gross income requirements of accession of wealth, clearly realized, between control. There must be a loss with respect to, there must be a triggering event, and it must be sustained during the taxable year. In this video, we'll consider the last topics of special rule for worthless securities under 165G, and also a special rule with respect to characterization of losses. So, the special rule for worthless securities. IRC 165G1 permits a loss deduction when securities have become worthless, meaning that they have completely lost value based on all the facts and circumstances. Now, this is important because this special rule that's carved out is important because, as I mentioned, for a loss to be sustained, there usually has to be a sale or exchange with respect to the event, triggering realization, the realization event. This is so that if you own securities and the securities go down in value, right, that's a economic loss, an unrealized loss, but there's no realization on the actual event. So when we have a sale or exchange, there is a realization event. So when you own a security, the mere decline in value, so that's what this is really contrasting. Mere decline in value versus a security that is completely worthless. Worthless meaning that it will never go back in value. It's possible that the securities go down to zero, but they might go back up. Now that seems very rare, which it is, but still, for securities to be considered worthless, they can never go back to having value. Never go back to having value. Now another thing is that, again, the sale or exchange component must be there, but as you now are now seeing that worthlessness doesn't really, that's not the same as sale or exchange. So there's actually a constructive sale or exchange that's basically put in place through this provision. So it's like a constructive sale or exchange. That's what 165G1 does. It's like a constructive sale or exchange. And that's really the purpose of having this special rule. Because as long as the loss is sustained, even though there's no identifiable event, which again is a sale or exchange. So the conditions require that it must be a security. So we must have, there's three conditions. The conditions are that it must be a security. The security must be a capital asset, which in later discussions we'll talk about capital assets. But for now, just note that as long as you're not a dealer or trader in securities, then a security to you is going to be a capital asset. And then third, the security must be worthless. So the security must become worthless during the year. Must become worthless. And again, the worthless requirement means that it can never and ever, in the future ever be considered, ever go up in value. Now, one thing to note is, again, this constructive sale or exchange is occurring in the year it's worthless. It's actually deemed to occur on the last day of the year. So it's deemed to occur on the last day of the tax year. So if you're an individual in a calendar year, then it's going to be deemed to occur on 12/31 of that year. Now, the last topic to consider with respect to losses is the character of deductible losses. And I've kind of already gotten to this with the worthless securities. It must be a capital asset. But really, in characterization, it will be discussed in detail further on. There's really, in terms of the character of losses, there's various types, but the main types I want to talk about here are ordinary versus capital losses. Now, I want to just, again, this is kind of like a brief introduction to characterization, which is another discussion. But with respect to ordinary versus capital losses, it's better to have an ordinary loss. It's better. That's a theme that taxpayers want because capital losses are limited generally to capital gains. They offset capital gains. And depending on the type of taxpayer, you might be able to offset some of your capital losses that have gone beyond capital gains, offset capital gains with ordinary income. So right now, the time of the video, it's $3,000 for individuals beyond just capital gains. Capital losses can offset ordinary income. But that might change in the future, so make sure you look at that. There is an ordinary income amount that's usually allowed to be offset, but it's very limited. So if you sell something, if you're an individual and you have $1 million in capital losses because of a recession, and you have no capital gains during the year, you're going to have to carry that loss. You can only use $3,000 against your ordinary income. Again, that's the rule current year. But then you get to carry forward indefinitely. But if you don't use it, it can never be transferred to anyone. Now, there's some special ways. There's some special things that taxpayers have done. It's an interesting topic. There's articles and stuff written on this where maybe somebody with capital gains marries somebody with capital losses, and then when the marital unit comes together, they can actually offset the one spouse's capital losses in the past with the other spouse's capital gains for a year. That actually can happen. It's a very interesting concept. And that there's been some discussion on that because it's more theoretical, but I'm sure it's happened in the past and whatnot. So I just want to make that aware is that characterization becomes very important, which again is a later discussion, but it's very important because with ordinary losses, there's really no limitations on your ordinary income. With capital losses, you're limited to offset your capital gains and only a very small amount, if any, of ordinary income. And ordinary income has generally, historically, had the higher rates than the capital gains or losses. There was a few years in the past where they were the same rates. They pretty much result in the same rates. Other than that, the only thing I want to mention is that gambling losses for individuals, you can only offset your gambling losses with your gambling winnings. You can't go beyond that. And this really concludes our discussion of losses.